I'm Dylan Ratigan. I've interviewed nearly every CEO and most world leaders during the past 25 years. And now I'm bootstrapping. I'm turning my attention to the new CEOs and the irrepressible entrepreneurs leading the next generation of innovation in the world. Welcome back to Tasty Live. I am Dylan Ratigan. Time for some more bootstrapping. My guest today, Robert Oakham, the company Van Oak Capital. Very interesting reading about the business. I'll let you explain it. What do you do, Rob?
So,
What does the business do, I should say?
first of all, thanks for having me on, Dylan. I appreciate your time. What we do is we lend money short term to investors to purchase real estate. Uh, Investment properties only, no commercial loan, no consumer loans, no owner occupied loans. A typical borrower would be someone who's looking to purchase a house, rehab it, maybe refi and keep it as a rental property. Either rehab a property and sell it to a retail investor, a retail buyer, someone looking to buy a home to live in. That's our bread and butter model. We do multifamily. We have a very strict lending criteria that we do. So an investor would borrow money up to 6 months, above market interest rates, much higher than the bank would lend to. Our rates start at 12, go as high as 20. And the idea being you borrow our money because you have a specific use for it, i.e. purchasing real estate either under duress, either for a special situation, maybe it's a probate issue, for tax issues, for whatever their reason might be. They have the borrower, the investor would use our money to take down the asset and then have a plan to get out of it.
Mm-hmm. And so one thing that I noted in reading the profile of the business is one of the features of your financing or your banking sort of service is very quick evaluation and funding. Hours or days, not weeks or months. Can you elaborate on how quickly you can turn around an approval and why that's relevant?
Sure. So oftentimes borrowers compete with cash buyers. We are the alternative for that person who doesn't have the money to present cash. They can use our funds and say, I am paying cash. Where they're getting it from is a private lender like ourselves. So we'll provide that funding. Prior to that, we'll get the property address, wherever that location might be. We do an internal comp, an appraisal that we think the property is worth, and our LTV, loan to value, will be up to 65% of what the actual retail value might be after the rehab, fixed up, whatever they're planning to do with that. So all we require is everything has to go through title. We must be in an insured first lien position by a title company to make a loan. If that's the case, if it's an investor, as I said, not a consumer loan, if it's underwritten by a title company, the policy itself ensuring our first lien position, the borrower needs to have proof of insurance, both for full replacement costs and liability on the property. We can close pretty quickly. If title is open and they're ready to go and it's clean title, and here's our number, we can fund now.
No, I understand. That makes sense to me. But my sense, and again, I have not completed more than a handful of real estate transactions, and all of them were just relevant to my own housing. So I'm not a real estate investor, but my perception is that having let's say the property is worth $100.
Sure.
One, proving it's worth $100, so now you'll loan me $65.
Correct.
And then having a title company that agrees with all that, and the building's been inspected, and whatever, asbestos this, C of O that, TCO this. I mean, there's a lot of things that fly around in the real estate business in terms of permits and regulations and on the roof, and is it insurable? What about the hurricane? Never ends. I got to make it through all that. At least that's my perception. And then I have to get through the bureaucratic aspect of the title company saying, okay, first lien goes to these guys, et cetera. Right. How is it that you can turn around a loan in a matter of hours or a day and make it through that filter?
So if you're a first-time borrower, customer of ours, it's probably not going to go that quickly. To your point, I want to go see the property. I want to meet the borrower, get, what's his or her track record? How many properties have they done? If you're a first time, call it rehab, or, I'm probably not going to do the loan, or I'm not going to give you what you're looking for.
Like if it was actually me and I'm like, oh, hey Rob, I'm 50 years old. I've got some businesses. I've done some things. I had success. I've got a couple of bucks. It's fine.
Yeah, yeah,
I'm looking to do this. You want to fund me? You'd
yeah.
say maybe, but let's take our time. You wouldn't be like, okay, Ratigan, here's $1 million. Good luck.
No, no, and I might say, Dylan, you know what? Using your $100 model, I might give you 50.
Okay, you
Because
just
I
discounted
don't know
heavy.
you, right? I don't know I don't know your track record. I want to see. I know that I can fund. I don't know that you can do what you say you can do, right?
Mm-hmm.
So prove it to me. If you take the example of funding quickly, they're usually people we've done a lot of business with. They have a track record. I funded a loan in an afternoon with a borrower that I did a lot of business with, who had a loan coming due with another borrower, and said, "Hey, I need you to replace this for 10 days." And
Mm-hmm.
so when I say we can fund it today, we did do that
But
loan.
that's with that would be with a really good high level KYC,
Yeah,
basically the
yeah,
ultimate sort of KYC.
correct.
Yeah, yeah. Okay, so then let's get into the business a little bit.
Sure.
Who's your competition? Is there competition?
So,
Like, what's my alternative to you?
well, there are a lot of the private lending space since 2008 has exploded. There's different versions. So we would be the short term slash hard money lender that people compete with, usually state by state. A lot of the hard money lenders, like we're in Chicago, I'm in Chicago, so there are people that deal specifically with just Chicago. If you go into the broader private market where you provide 30-year money, which would be the people who would take us out of our loans, those tend to be national players, and Wall Street backs a lot of those guys. They like the space, they like the model, they do it again, not consumer loans per se. They do more DSCR, which is debt service coverage ratio loans, so that they'll look at the asset and say, okay, here's a fourplex. It produces X in revenue. We can put an expense ratio to it, and this will be the loan we'll make on that. Our competition is more local. What we do different than most is we don't sell our loans. We pool them and run our company as a fund. So currently we have over 100 loans that we're managing. We've closed over 1,600. We've closed over $150 million over the course of our business. The model we use is, here's an interest rate we're going to charge, no points, no fees. This is it, interest only, till the balloon payment comes due in 6 months. In theory, that's how it technically should work. Oftentimes, other lenders will say, okay, we're going to be much lower in interest rate. We're going to charge 2 or 3 points. We're going to charge an inspection fee. We're going to charge this. And often and most times, the numbers come out to be around the same. But I think it's sticker shock oftentimes if I'll say, okay, we're going to charge 16% on this loan, 18% on this loan. It's like, my gosh, that seems like a lot of money. Fair enough, right? It is. But, you're not keeping this loan for 4 or 5 years. You hope to keep it 3 to 6 months because you have a specific need for our capital. You have an exit in mind, and that's
You
the
just
use.
you just need a few months to get your lower cost financing in place.
Exactly. Exactly. So in the shorter term, if you're paying points, you're actually paying more, right? I mean, if it's a 6 month loan, mathematically, you're going to pay more for 3 months than you might for 12. It's a better deal to use the
Mm-hmm.
points, I would say.
So then
But
you mentioned that you're not laying the debt off, you're carrying it as a fund. What's the return on capital been and how consistent has it been? What's the range year over year? Like what's your best year, what's your worst year, and what's your average?
so our initially we started off in Phoenix in 2009, and the market there had just collapsed. I think top to bottom up to 45%. We did a lot of loans because there was virtually no capital, certainly from the banks. I mean, any credit anywhere was good if you could find it, right? So we did a lot of loans, and those were really good years for us. We turned properties over a lot. We had a lot of volume throughout the week, and so the issue we ran into was, raising capital, because we initially funded it with our own, and if you're doing a lot of real estate loans, that gets chewed up pretty quickly, right? I mean, unless you have an unlimited supply of funds, which we don't.
Mm-hmm.
So we paid our investors. We pay our investors X. We lend out at Y, and we collect Z. It is kind of our model, right? So our investors have been paid, 10% every year. And I would say some of the,
Have you had a bad year?
yeah, we've taken properties back. I mean, every lender takes properties back, and but that
What
comes out.
percentage have been non-performing?
So I would say out of 1,600 loans, I would say no more than 70. That would be high, I would think. So 3% maybe.
Mm-hmm.
And it typically will be if, a couple examples. One, I had a borrower here who just blew up. And so I took back 8, 9 properties at one time. That's happened to us in another market. And from our position, what my partner and I often talk about is here's their balance with us. I don't know what they have with another lender. So we always say, okay, we'll give them $1 million balance up to 1 million. That's what they can have with us. Because if they're really playing a lot, they could have $1 million balance with 3 other, right? And so that's
All over
pretty, yeah. And so those are the issues, those are the instances, excuse me, that we have had taken properties back. Guys who don't know what they're doing, don't know how to, as you said,
But does that become non-performing, or does that just become a longer duration because ultimately you are going to be able to liquidate the property?
both. So sometimes it's better just to take your loss and get out of it, right? My partner and I both have real estate experience, so we understand, okay, if we can get our contacts in certain markets to help us either rehab and sell, we'll just carry those assets. And we often do that to just try to work our way out of it. Again, we have a pool, so it's not a one-off that we're selling and we're taking it back. So it kind of spreads the risk that way.
Mm-hmm. And how big of a business do you think this could be? In other words, you said you started in Phoenix. Obviously, you're in more than one city now. You've been at this for whatever it is, 15 years, it sounds like.
That's
And
correct.
what is your vision on growth? Especially, obviously, you must have some book of investors now that probably feel more confident in you. You have a track record, et cetera. I'm just interested in sort of how much money you think you could raise and how much money you think you could put to work in this business model.
So currently we have just under 20 million working. COVID slowed us down mainly because we pulled in the reins. We got cautious, raised capital just to kind of see how things were going to play out. As it turned out, it was the worst thing to do. Rates plummeted, investors went crazy, so we hit the accelerator again. Having started in 2009 in Phoenix, I mean, the scar is always in the back of our mind, like, okay, let's make sure we don't revisit something like that and we're holding a bunch of paper and properties and things like that. To answer your question directly, we raised capital in July, we raised some more in August, and we're in a growth mode. We've invested in the last 12 to 18 months in infrastructure to kind of streamline what we are doing, more from a smaller operation to a bigger one, because we do have demand right now, pretty good demand, and it's again time to raise capital and to fill that. So I think we could easily double what we're doing, not in the next year. I mean, it takes time, but certainly over the next 3 to 5 years for sure.
And what's the limiting aspect of that growth? Is it the manpower and administrative aspect? Is it the availability of resources, or is it the availability of deals?
Good question. It's kind of like the chicken or the egg, right? Do you raise a lot of capital and hope you can find the deals, or do you get the deals and then you have to raise capital? I think the former is is more problematic, as you can be sitting on capital and we're paying on that capital, so we have to deploy it, right?
Mhm.
I think having been in the business, having been in certain markets, and we do have boots on the ground relationships in every market we do. We don't ever outsource that. Outsource that. When we do go to a market, we go to the market. We have, you know, once a month we'll go to a different. Like we were in Houston last week. We hosted dinner with a bunch of our investors, a bunch of our borrowers. What's for two reasons: one, to see what they're seeing, any changes in the market. Also, guys, we're here for you too. We're your biggest cheerleaders. We want you to succeed, not to fail. So it's more of, right now, I would say capital raising is where we need to, and we're focusing on. We are raising capital, but that's the deficiency right now of what we're doing.
Mm. And do you have a point of view on the American real estate market? Just to make, I'm going to switch you from CEO and fund manager to credit analyst and macroeconomist. But any relevance of the rate cut cycle kicking off? Any insight in your point of how much are investment real estate deals even an indicator of anything? Do you have a point of view on the strength of the American economy and the American real estate market in any
Uh,
way?
my background is in finance. And I have been in real estate, but I also traded on the CBOE for a number of years. So I'm acutely aware of interest rates and how it does affect everything, right? So when we started, and I'll just use Phoenix as an example, in 2009, I mean, as I said, the market, they were practically giving homes away. Since COVID, that market's up 40+%. Austin, Texas, the same thing, almost doubled in some spots, right? So that's a market we will lend in Phoenix because we know it, but we're real cautious. We stick to a strict 65%. We try to get people 10, at minimum 10% down, if not 20% down on the deals that they're doing. And that's key to lending, because if someone has skin in the game, they're less apt to walk away. We're not 100% lender. So we do require that. As far as the broader economy, I kind of think it's counterintuitive, but I kind of felt like when interest rates shot up, that prices would come down, that supply might go up, but with a large percentage of homeowners locked in sub 4 rates, sub 3.5 rates, the supply never came on. Unless you have to sell, you're probably not going to. So as I think with the mortgage rates just slightly over 6, as they get into the 5s, you might see some trading around, some people getting out of some of those for a nominal cost to trade up to another property. I would say the difference between now and '08 is most banks are pretty healthy. I would say that most people have equity in their homes, that they're not super levered. So I think that's a change from 2008. I'm always cautious. I traded the '87 crash, so that's, things do happen out of the blue, right?
You're too old to be too optimistic. You've seen too much. I
Right.
understand. You and me both. Rob, it's a pleasure. Nice to talk to you. Thanks for the time today.
You as well. Thank you.
All right, Rob Oakham, the company Van Oak Capital. I am Dylan Ratigan. You're watching Bootstrapping. Some more tasty live coming up right after this.